Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Hello and welcome to the Australian Finance Podcast. I'm your host, Kate Campbell, and today I'm talking to the wonderful Dr. Sam Wylie. He has a PhD in finance. He's an associate professor at Melbourne University, and he loves teaching investors how to invest. Sam, welcome to the show today.
Thanks, Kate. Thanks for inviting me back.
Now, I'm very impressed you're doing this at 5:30 a.m. in Perth, so we really appreciate your effort coming on the show today. But just for a bit of introduction, if listeners haven't heard you on a previous episode we've done together, what is your role? What are the things you do? What gets you out of bed in the morning?
Well, I've been an academic for a long time and industry consultant. And so I was a teacher and researcher at the University of Melbourne, and before that in the US at Dartmouth, before that at the University of London where I did my PhD. So I've been an academic for a long time. And about 15 years ago, I started doing quite a lot of consulting to big corporates like BHP and then to super funds. And then I moved more into investment management, started a teaching company with my wife, Tracy, which is called Windlestone, which teaches courses on investing for investors. And so I've been sort of transitioning from being a full-time academic to being more of a consultant and teaching business owner.
What was it about finance that drew you to doing a PhD? Because a lot of our listeners are interested in finance and managing their own, but doing a PhD would seem a bit next level.
Well, I did it because I wanted to be an academic. Otherwise, I would have done an MBA, I think. You know, I studied engineering and then I worked for the federal government after I finished my studies. I thought I might do an MBA and become an investment banker or something like that. So I started studying economics, and then it was really economics that I fell in love with, and then microeconomics, and then finance as a part of microeconomics. So, you know, microeconomics as opposed to macroeconomics, but economics in general is really about how people make choices about resources. How am I going to spend my money? How am I going to spend my time? Where am I going to work? What am I going to invest in, etc. And how much I'm going to pay if I'm a company. How much am I going to produce of this wheat or this oil or these widgets or this software? All of those individual choices. That's what economics is about. And then how those individual choices all add up to something in aggregate, add up to inflation or unemployment, exchange rates, interest rates, you know, those kind of things. That's what economics is about. And then finance is specifically about the financial part of the economy, about the markets, the capital markets like the stock market and the bond market, the risk markets, where there's people get insurance and transfer risk, the risk of the foreign currency, the Aussie dollar will go down, the risk of interest rates will go up, the risk of the price of oil will go down. So you've got the capital markets, you've got the risk markets, you've got the money markets, where people store money. And then you've got big financial institutions like banks, investment banks, insurers, superannuation funds, etc. That's the financial part of the economy. And finance is the economics of that thing, of those markets and those institutions.
So it sounds like it was your way of getting curious about the world and figuring out how everything worked and tied together.
Well, absolutely. And, you know, the great thing about microeconomics, this is why I loved it so much right from the start, is that it gives you a framework for understanding things that you couldn't previously understand, that you thought about, but you couldn't really understand. You couldn't fit all the pieces together. And then there was this coherent and logical framework where all the parts fitted together, and it explained so much. Right? It's so powerful in what it could explain. And so I had that feeling, and that feeling's never gone away about economics and finance, just how powerful it is, meaning how much it can explain, and how coherent it is, meaning that all of the parts fit together. You know, and that feeling of the power of economics and the coherence of it, that's never gone away.
Well, something I'd love for you to explain to us is about how interest rates work, maybe a little bit of what they are, how they work, and why they impact our lives.
Well, they impact our lives because they're the cost of capital. If you are borrowing money, then it's what you have to pay to use somebody else's money. So capital gets formed by people saving. So either when you earn your income, and then the part that you don't spend and the part that doesn't go to the government as tax, that part gets saved. And that forms capital, because what do you do with it? Well, you put it in the bank, and then the bank will lend it to somebody else. Or you put it in your super, and then the super fund, Aussie Super for instance, will invest it in something. They'll invest it in the stock market or the bond market or in real estate. They'll make capital investments. So it goes into the bank, and the bank will lend it to someone, or it goes into the capital markets. And so the reason it really matters, Kate, is because if you're a borrower, then it's the cost of borrowing other people's money. And if you're a lender, then it's how much you receive for lending your money through banks, through your super, etc., to somebody else. And so, that's why it's absolutely crucial. And the biggest thing that most people want to borrow for is housing, of course. So, Australians are critically interested in interest rates because it goes directly to what they have to pay for their mortgages. And we have floating rate mortgages in Australia. That's not true in every country. In the US, they mostly have fixed rate mortgages where the interest rate is fixed for 30 years. Those are really long-term interest rates. But we have very short-term interest rates where the central bank, the RBA, sets the interest rate, and then there's a margin on top of that that is charged by the banks.
Because it's interesting, isn't it? Because the RBA have their discussion every month, and we see lots of newspaper articles come out of that. But sometimes we don't feel the impact of that directly ourselves.
Well, no, not. We feel it through the banks. We don't. The RBA is sort of. It comes to us through our mortgages and through other things. And the RBA is kind of a very distant thing, really. I mean, they meet in different parts of Australia for different meetings, but the RBA is based in Martin Place in Sydney. You can see the Reserve Bank of Australia there. And they meet every second month. Nowadays, actually, they used to meet every month except January, but they've changed recently. Now they meet 7 times a year, I think it is. So they meet about every 6 to 8 weeks. And they decide what the cash rate is going to be. They decide and that rate is actually, what it actually is, Kate, is the rate at which banks lend each other money overnight. So it's an interbank interest rate. And so it's the rate at which banks can acquire short-term money. And then banks need to put a margin on top of that to run their business and also to achieve distribution. You know that most mortgages now are signed through brokers rather than through bank branches. It used to be that almost all mortgages were done through bank branches, but now only about 30% of mortgages are done through bank branches, and all the rest are done through brokers, and the banks have to pay them. So the banks need to put a margin on top of what it costs them to get the money. The RBA sets the rate at which it costs the banks to get the money, and then the banks charge about 180 basis points to 190 basis points, 1.8% to 1.9%, on top of what the cash rate, and they do that to make a profit, to pay for all their operations. They have to hold a lot of capital to keep the regulator of the banking system happy, and so for all of their costs, they put a margin, and it's really competition between the banks that squeezes that margin down. Sometimes it blows out. If there isn't enough competition between the banks, then mortgage rates will be floating. Variable mortgage rates will be the cash rate plus 220 basis points, 2.2% or 2.4. That happened after the GFC. But now we live in a period of a lot of competition for the banks, and it squeezes that margin, like really in any industry. If there's a lot of competition, then it squeezes the margins that the suppliers can charge. And so, that's how the RBA fixes the cash rate, and then the banks charge a margin on top of that. So the cash rate at the moment, 4.35%. Put 180 basis points on that, and you're at 6.15. And that's kind of what variable rate mortgages are at the moment. Maybe you can get a really good deal down around 6%, but most people will be signing them at 6.1, something like that.
How does the RBA make their decision to raise or lower the cash rate on a monthly basis?
Well, they're governed by legislation, the RBA. They're independent, but they're governed by federal government legislation, the RBA Act. And it says that they have got two things that they have to pay attention to inflation and to full employment. Now, it's a bit unfair because they've only got one lever. They only got one lever, one thing to move up or down. And if you've only got one thing to move up or down, you can only really control one thing. So the government should really say that you've got to control inflation or you've got to keep employment at a full level in the economy. But because they've only got one lever, but they mostly target inflation. So they're required to target full employment, but they mostly target inflation. And so if inflation is running too hot, which is what happened in COVID, of course. So at the beginning of COVID, there was a great panic that the economy would crash, and the economy did start to crash, and inflation started to fall quickly. People weren't spending any money, so there wasn't any demand, and so the price of everything started to go down, basically. And then the RBA wanted to speed up the economy, so it pulled the lever down. It lowered interest rates to try to speed up the economy. And then later on in COVID, when there was not enough supply because all the supply chains got tangled up, and there was a lot of demand because the government pumped a lot of money into the economy to support the economy. Later on, the economy started to overheat. So then they raised interest rates to slow down the economy. So why does lowering interest rates speed up the economy and raising interest rates slow down the economy? Well, it's for a couple of reasons. So one is that when you raise interest rates, then people think, okay, it's more worthwhile for me to save now. Because you can think of interest rates, Kate, as an exchange rate. An exchange rate, not between Australian dollars and US dollars, but an exchange rate between Australian dollars today and Australian dollars in the future. That's what interest rates are. Put $1 in the bank, and in a year's time, if interest rates are 5%, you'll have $1.05 back. So it's like an exchange rate between the present and the future. And when interest rates go up, then that exchange rate becomes more favorable for saving. You'll have more in the future. So people do save more and they spend less. And because they spend less, there's less demand in the economy, and it slows the economy down a bit. And it's also true that not on the saving side, but on the borrowing side, now the cost of capital is higher. So people borrow less and invest less in the economy. So you got less demand from consumption because people are saving, and you got less demand from investment, the building of buildings and factories and equipment and the like, because the cost of capital has gone up. And so those things are really what slow it down. And the opposite happens when the RBA wants to speed up the economy by lowering the interest rate. Yeah, it's the big lever that the RBA has in the economy.
Have you thought about what other solutions there could be apart from that one lever?
Well, there's the government's got a big lever.
Yeah.
So the government has that. The RBA's lever is called monetary policy, because the way that they actually speed up or slow down the economy, the way that they raise interest rates or lower interest rates, is by withdrawing money from the economy. I know putting my fist up in the air looks like I'm actually making something higher, but we're making interest rates higher by pulling money out of the economy. So the RBA sucks some money out of the economy. Now there's less money in the economy, so the price of money, interest rates, goes up. And when they want to lower interest rates and to speed up the economy, then they push more money into the economy. And now there's more money sloshing around, and because there's a bigger supply of money, the price of money goes down, interest rates go down. So it's called monetary policy because they are bringing the changes in interest rates about by either increasing the amount of money that'll lower interest rates or reducing the amount of money in the economy. And the RBA can do that. They can control the amount of money in the economy. So that thing is called monetary policy, what the RBA does. But then the government has its own big fiscal control, how much spending there is by the government, how much they raise in taxes and how much they spend over time. And so in COVID, when the government wanted to stimulate the economy, it ran big government deficits. So it borrowed a lot of money in the long-term bond market, and it spent the money. It handed out a lot of money to people to help them through the COVID emergency. And everyone agreed that was absolutely necessary. But so the government, when it wants to speed up the economy, it decreases taxes, so people got more money to spend, and it increases its own spending to speed up the economy. And when it wants to slow down the economy, it increases taxes and decreases its spending. So you got the RBA has the monetary policy lever, and the government has the fiscal policy lever. Now, in some countries, not in Australia, but in some countries, the government also has a lever which is wages. The government can set wages, and that used to be true in Australia, but it's not anymore. Not since really the Hawke and Keating government. But in some countries, quite a lot of countries, the government sets wages, and so it can raise or lower wages. Then you've got three levers. And in other countries, the central bank controls the exchange rate. That's true in China, as for instance. But that's not, and that used to be true in Australia a long time ago as well. But the freeing up of the economy in the 70s and 80s really involved getting rid of some of those levers. And now we just have the RBA with monetary policy, interest rates, and the government with fiscal policy. But in some other countries, you got wage policy, you got exchange rate policy, etc.
I think it's good to have an explainer on that, because the RBA got a lot of the negative press over the last few years because they were just doing what they had to do, but it was impacting people's lives because they were suddenly going from a 2% or 3% interest rate on their mortgage to paying 6%, and they're having to come up with all of this extra money every month.
Look, and they had to act quickly in COVID. People, it's easy to forget what the feeling was in February 2020 when it was a very scary time. It was a scary time, and
companies laid off people immediately in that Feb-March period.
Absolutely, everyone went home. I remember on March the 13th, it was a Friday. I flew home from Melbourne, where I'd been teaching at the business school, Melbourne Business School, to Perth, and then the dean closed the business school. Just everyone got an email saying, "Don't come back. The business school, the whole university, is closed, and we'll let you know when it reopens." But it wasn't for ages. It was for like 18 months or something. Another reason the RBA was criticised quite reasonably was they made promises that they couldn't keep, and they made unreasonable promises. So Philip Lowe, who was the previous governor, not Michelle Bullock, who's the current governor, he said in 2021, "I don't expect that interest rates will be raised until 2024. And of course, they were raised, a year and a half earlier. Times. Look, and people made decisions on that basis. So when the governor of the RBA says, "I don't think we're going to raise interest rates until the middle of 2024, and it's 2021, and you're thinking about whether to fix your mortgage or not, you're thinking about whether to get a big mortgage or a smaller mortgage, you sort of take him at what he said. I mean, he's the governor of the RBA, right? So you think that
he's the smart one in the room.
Not only the smart one, but the one who's got his handle on the lever.
Yeah,
he's actually holding the lever. He's the person who can determine whether interest rates go up or down. So he really is. So that they were criticised a lot for that, and there were some other promises that they made that they couldn't keep. So that damaged the credibility of the central bank, and the credibility of the central bank really matters in the economy. So I think that's, like you pointed out, that there was unjustified criticism, but some of it was justified.
Do you think they're being extra careful now about what they say in any media release?
I think Michelle Bullock's an impressive governor. I think she was a good choice by the board and by the treasurer. Ultimately, the treasurer Jim Chalmers has to agree to the new government. Is a very good economist, and that she's being very cautious. Yes, and I guess what the subtext of your question is are they going to make promises that they can't keep again? And
Well, should we be mindful when we listen to these statements?
Yeah. So is their credibility so damaged that we should have that in the back of our mind? I don't think so. I think that was a one-off. And I think it'll be a very steady ship under Michelle Bullock.
Can we also talk about the housing market? Because a lot of our listeners have purchased their first property. Maybe they've just got their foot in the door with an apartment in the city. Maybe they're looking to upsize when they're starting a family. They're looking to buy an investment property. And for a lot of people listening, property does still seem quite out of reach. And it just, every time they save a bit of that deposit, it just gets a little bit further away from them. Can you explain maybe how you see how we ended up here and why property just feels so out of reach for the younger generation?
Well, I think we have got a housing crisis. And, in 2024, everything is a crisis. Whenever anything happens, it's a crisis. But I think the housing crisis is a real crisis. And it's basically a problem of too little supply. Now, we do have a rapidly growing population from natural increase in population and from a lot of immigration. I personally think that's a happy thing, both of those things. So we do have an increase in demand, but mostly it's a supply problem. And it's a problem that not enough land is released for the building of apartments and especially building of houses in outer suburbs. And there isn't enough supply of skilled labour to undertake the construction. There's people are reluctant to move to regional areas, and regional areas, towns in regional areas, don't release enough land. They're reluctant to have a lot of people to move to where they are. So, look, it helps to compare Australia to the United States. So, in Australia, the average house is about 6 times household income, disposable income. And in the United States, that figure is less than 3. The price of an average house. And it's not like the housing stock in Australia is vastly superior to the United States. The US, there's more separation. Low-cost housing is really pretty ordinary in the US, but they have a lot of very high-value housing as well. In Australia, it's a bit tighter. The average sort of housing, so the average house is pretty good. But we can think of the housing stock as being quite similar in the US and in Australia, but it takes half as many years of average household income to buy the average house in the US. And look, it's the things that we've been talking about here. So one is that zoning laws are much more favourable to building houses in the US. And communities compete really to attract people to their community. And they like to build a lot of housing. And that's partly because of the way the tax system is structured in the US. But they don't, you don't have people resisting the building of apartments or new houses in their communities in the way that you do in Australia. And then you have sort of quite a big supply of skilled labour in the US. It's sort of a competitive economy. A lot of people go into construction. And then people in the US are more mobile. So, if you say to someone, okay, well, if they build more houses in Wollongong, would you move from Sydney to Wollongong? Or would you move to Port Macquarie? Or would you move from Melbourne to Ballarat? And a lot of people are horrified by that idea. It's sort of like, I'm not leaving North Fitzroy. I'm not leaving Balmain to go and live in Wollongong. I'm not going to do that. So, but that's actually part of the problem, right? Like if everyone wants to live in Sydney and Melbourne and Brisbane, then it's the supply problem probably never goes away. So, but look, that's not the biggest part of the problem. The biggest part of the problem is the resistance to the release of new land and of zoning permits and the supply of skilled labour to actually build the houses. Yeah. And those are deep structural problems. I don't think that's going to be fixed anytime soon. And the federal government and the previous governments, I'm not sort of making a party political statement here, governments of every political stripe haven't really made much of a dent in that problem. So I'm not expecting that to happen anytime in the near future.
Yeah, because there's been lots of different schemes to get people into housing and create new houses, but they haven't seemed to impact the problem very much.
Well, the First Home Super Savers scheme, which is absolutely terrific, we should come back and talk about that in a minute. They really increase demand. They don't build any new houses. to build new houses, you need more land and more labour, and that's what the government's got to really focus on. The federal government and state governments have got to spend some of their political capital to overcome local resistance to the release of land, so that we can build more houses and apartments, and more people can live in the houses that they want. And we need to orient our immigration system more to bringing in more people who are highly skilled, and orient our own domestic training of people to having more people who are skilled in building houses. But the First Home Super Saver Scheme, have you ever spoken about that on the channel a bit?
Not for a while, but I think we've briefly talked about it before with some financial advisors.
Well, let me just rehearse it it'll only take 1 minute.
Yeah, so go for it.
You're allowed to take $50K out of your super to put into your deposit for a home, but that $50K has to come from contributions that were on top of compulsory contributions. So, let's say that you make $60K a year, and so you got to make 11.5% compulsory contributions. So 11.5% of 60 is 6,900, right? Is 6,900. So you got to pay 6,900 into your super, 11.5%. Your employer has to do that, but you can make contributions, pre-tax contributions on top of that. Everyone knows that, but it's those pre-tax contributions. Put them into your super, and they grow in your super, and you only pay 15% tax on the way in, and you only pay 15% income tax and 10% capital gains tax while it's in your super. And then it grows to 50K, and then you take it out. And if you're a couple, you can take out 50K each. And you compare that, the alternative to that is that you have your salary, you pay your tax, and on 60K, your marginal tax rate is going to be 32%. So instead of paying 15% and the money going into your super and growing at a low tax rate, you pay 32% and the money goes into the bank, and you get a lower return, and you have to pay tax on the interest anyway. So it's an absolute no-brainer. If you are saving for the first home, then you should use the super system to do it. It's dead set no-brainer. Yeah, everyone should do that. Everyone is saving.
If you're absolutely certain you're going to buy a home.
Yeah, if you're absolutely certain you're going to buy a home. Yeah, because otherwise that money is stuck in super until you're 60 years old.
I mean, it probably will boost your retirement savings if you decide not to buy a home.
Yeah, that's exactly right. So it'll be good anyway, right?
Yeah. So it sounds like a lot of those issues you talked about with housing are not ones that we directly as individuals, unless we're in local council or state or federal government, have any control over. Is there anything that we can do as individuals maybe to help get into the housing market? You're right to say that you can't directly influence government policy, except that we should remember that the reason that federal and state governments don't pay enough attention to this is because they don't think that voters are paying enough attention. I mean, the politicians are what they are. They're very responsive to the feeling that they'll get voted out of power. And they're balancing the resistance of local communities to allowing more housing against the demand for more housing. They're sort of balancing those two things. So, as individuals, we can put pressure on the government to be a bit braver in taking on the local communities and changing, and also, bringing in more skilled labour into Australia. But in terms of you've got to figure out what your plan is. So where are you going to live? Obviously, that's associated with your life goals. Start building your budget. Make sure you use the First Home Super Saver Scheme. Make sure that you use the state-based and sometimes federal government first home buyer schemes. Accumulate your money in the quickest way that you can. Have a good and
and achievable target in getting into the market relatively early. So don't think that the property that you're going to buy is the property that you're going to live in for the rest of your life. I guess that's the thing. Don't be too ambitious. Buy something that you can get into relatively quickly, and then you'll have enough exposure to the market. So as the market goes up, you'll already be, in an apartment. You want to live in a house somewhere in a leafy suburb, but there's more than one step to getting there. You're going to buy an apartment in the city and get some exposure, or you're going to buy a house on the outer suburbs, and then you're going to upgrade later on. So, look, I would say have a good plan, save hard, use the right mechanisms for saving. The First Home Super Saver Scheme, the First Home Buyer Schemes from the federal government, the right ways to grow your money quickly in terms of it being tax efficient and also getting a good return on your money. And then be realistic about getting into the market early and then upgrade to the house that you want. I would say that those things are really crucial. And of course, I haven't mentioned here the bank of mum and dad, right? Which is because not everyone has access to that. So I didn't go to it until the end, right? But a lot of people do, and most parents want to help their kids, right? That's the thing they want the absolute most is to help their children. So I have 3 children who are sort of your age, Kate's 20 something, and they are, and my wife and I will definitely help them to get into the property market. So yeah, there's the bank of mum and dad as well. If you can tap into that, tap it as hard as you can.
Yes, it's a very contentious one because not everyone has access to it.
I put it last, right? That's why I didn't go to it until the end. I went to the other things. Yeah.
There's lots of options. Now, Sam, one of the final questions I wanted to ask is, we often get statements from economists on the TV and they'll say completely opposite things to each other. They'll say, this is happening with the market, and someone else will say this is happening, and different articles will come out. How much of that is noise, and is any of that worth listening to?
Well, that's a great question. And mostly it's the difference of, where there's strong differences of opinion, that'll often be because people are just, because it's merely opinion. When sort of someone is saying, I think that Tesla shares are going to go up, and someone else says, oh no, I think they're going to go down, and someone says, I think that property in southeast Queensland is going to go up, and someone else says property is going to go down, and I think the Aussie dollar is going to go up, and I think the Aussie dollar is going to go down. I think interest rates are going to go up. I think interest rates are going to go down. Look, I mean, if those people knew what was going to happen, then they would start a hedge fund and they'd be on a yacht in the Caribbean somewhere, right? They don't know. Almost all of that is just mere opinion. And what I would say is, okay, that's just noise in the background. There's noise everywhere in the background. But the crucial thing, Kate, is you don't want to pay for that mere opinion. You don't want to go to a financial advisor and have a financial advisor say, I know what's going to happen to the Aussie stock market and to interest rates and to the exchange rate, and I'll tell you what's going to happen here, right? And my attitude to that is, yeah, okay, well, if you knew all of those things, why are you sitting in this office in a shopping centre somewhere and not on your yacht in the Caribbean, right? It's because you're just making it up. It's just mere opinion. You're pretending to be super expert. So look, a lot of that is about that. And then the other part would be that it's sort of based in politics, that really what they're arguing about are different political points of view. And they're coming from different parts of the political spectrum, and they're engaging in economic debate. And because they're competitors on the political spectrum, then they go head to head in the debate. But if you went into the university, for instance, most of the time people agree about economics. It's not, people shouldn't think that if you the old saying that if you have 2 economists, you've got 3 opinions on every topic.
Yeah.
You know what they call a collective of economists? Like you have a mob, you have a flock of sheep, or a murder of crows. Well, the collective term for economists is a confusion a confusion of economists.
That's what it feels like sometimes when you read all of these headlines.
Yeah, that's right. And look, I mean, yes. So it's that people have got a political agenda. People are just talking baloney a lot of the time. That's what you find. But when you get into more serious discussions about economics, where people aren't guided by trying to appear to be super smart so they can charge you big fees, or guided by a political agenda, then there's a lot more agreement.
Yeah, sometimes it can be hard as a new investor to know if someone's talking about a fact, like this is how an ETF works, this is the structure, versus ETFs are always going to go up. So it's hard to differentiate sometimes.
Yeah, no, you're absolutely right.
Fact and an opinion.
And you should listen more to here's how ETFs work, right? And here's why ETFs are better than managed funds, for instance.
Which is why I asked you the questions of how does interest rates work, rather than do you think they're going to go up or down next month?
Yeah. I don't think they'll change next month.
Okay,
but I
got an opinion there.
like I was saying before. Look, I mean, at the bottom of interest rates in Australia is productivity. That's the problem. Productivity is abysmal in Australia. It's been falling since COVID, and in the United States, it's been rising quite quickly since COVID. Productivity, how much is produced by people per hour of work in the US is rising about 2% per year. In Australia, it's falling about 1% per year, and it's a significant part of the cost of living crisis in Australia, and that we just wages aren't going up because we're just not productive enough, and because we're not productive enough, supply isn't going up. If supply was rising faster than demand, then prices would fall. So until the reserves and improvement in productivity, I don't think she'll feel comfortable about cutting interest rates. So it's, I do have an opinion, but it's based on something very specific and easily measured, which is the level of productivity in Australia. We really have got a significant problem with that at the moment. And it's a lack of economic reform. There isn't enough sort of, you would have had people on the channel who have fintech startups and that kind of thing. And, you would hear people say in those contexts that to get a lot done, you've either got to have burning ambition or you've got to have a burning deck, meaning that there's an emergency, right? And that you can overcome vested interest and get things done. And unfortunately, our politicians in Australia don't have either. They don't have burning ambition to sort of revitalize the economy through reform, and they don't feel that it's sufficiently urgent, right? That's partly us, right? It's partly that we don't put enough pressure on our politicians to get on with it. They don't feel that pressure through the press, through the ballot box, etc. But productivity is a big problem, and it feeds into how quickly interest rates are going to come down in Australia. So I do have an opinion, but it's not just based on. It's not a mere.
I mean, at least you can articulate it's an opinion. I think most people would just say that my opinion is a fact.
Yeah, they just say it straight out as if it was a fact. That's right.
Well, Sam, thank you so much for coming on the show today. I loved having such a wide-ranging chat about lots of different topics. If listeners want to learn more from you and your investing courses, where should they head to?
They should go to our website, which is windlestone.com.au. It's WINDLESTONE.com.au, Windlestone.
Perfect. I will put that.
They just Google Sam Wylie, Dr. Sam Wylie, then they'll come to it pretty quickly. Yeah, thanks for inviting me, Kate. You're really good at this, so it's a pleasure to come on the show.
No worries. Well, I appreciate once again you getting up so early, and everything will be in the show notes. And thank you so much for coming on today.
You're very welcome.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.